Welcome to the debate. We're starting today in 1992. An investment group purchased this struggling little natural juice company called Hansen's Natural, and they got it for a mere $14.6 million.
Which is frankly pocket change in this industry.
Exactly, pocket change. But fast forward to today, and that exact same corporate entity generates over $7 billion in net sales annually.
Right.
It has a market valuation north of $50 billion. I mean, they didn't just tweak their juice recipes. They pivoted entirely and created the Monster Beverage Corporation.
A total mutation from a modest regional juice brand into this massive international energy drink empire?
Yeah, but that origin story is only half the picture. The central question for anyone operating in the fast-moving consumer goods sector, the international traders, the B2B wholesalers, the regional distributors, is how that massive valuation actually translates into local profitability.
Right, because paper value doesn't always equal a good trade.
Exactly. So does Monster's value as a high-demand asset stem primarily from its sophisticated institutional ownership structure and strategic corporate partnerships? Or, on the flip side, is its true market value only realized through the specialized supply chain resilience and export integration provided by regional wholesale bridges?
And I think we both know where we stand on this.
Oh, definitely. My position is that Monster's unparalleled stability and market dominance are the direct structural result of its corporate architecture. Specifically, I'm talking about its landmark asset swap with Coca-Cola and its heavy institutional backing. Together, those form an impenetrable economic moat.
Well, I take a fundamentally different view on where the value is actually realized. I argue that corporate cap tables and strategic M&A deals they're merely paper value.
Just paper value?
Yeah, in the complex realities of the global FMCG market, a brand's blue chip status only translates to actual tangible profit when specialized wholesale partners step in. You need them to provide the streamlined export logistics and competitive pricing to bridge that gap from a global corporate empire down to regional distribution.
Okay, well, to set the foundation for my argument, we have to look at the structural guarantees built into Monster's DNA. When a B2B wholesaler is looking to import a product, stability is their primary concern.
Sure.
And Monster provides an institutional safety net that is frankly unrivaled in the beverage category. First, there's their public trading transparency on the NASDAQ. Unlike private competitors, every strategic move is visible.
I'll give you that. Transparency is a plus.
Right. And second, and this is the crucial part, is the 2015 strategic partnership with the Coca-Cola Company. They hold an approximate 19.4% stake in Monster. This wasn't just an investment, it was a structural integration.
But that top-down perspective completely ignores the actual friction of global trade. Corporate architecture is incredibly impressive in a boardroom, but FMCG wholesalers cannot bank on corporate cap tables.
But they bank on the stability that cap table provides.
Do they? An importer in Southeast Asia or Europe faces massive regional supply barriers every single day. Yes, the structural integration with Coca-Cola scales the brand's presence globally, but macro-level availability does not equal micro-level profitability.
Well,
Hang on, if a distributor is dealing with unpredictable customs delays, fluctuating tariffs, or, sourcing inefficiencies, the institutional backing of Monster's stock means absolutely nothing to their bottom line. The true driver of B2B profitability is supply chain resilience.
okay, but
You see this play out with specialized export partners. Take a group like Asia Grocery Wholesale, for example, also known as Asia Grocery Company. Their role in bridging a market like Vietnam to the rest of the world proves that navigating customs checks and securing bulk pricing is what actually makes the product viable. Execution, not architecture, drives the margin.
I hear you, but you can't execute a trade on a product that doesn't have intrinsic demand. To understand what those localized distributors are actually buying into, we have to trace the foundational strategy of the founders.
Rodney Sachs and Hilton Schlossberg.
Exactly. South African-born entrepreneurs who took control in 1992. For a decade, they operated in the traditional beverage space, but in 2002, they executed this masterstroke. They didn't just launch a functional liquid with caffeine. They aggressively engineered a lifestyle brand.
Right, aligning with extreme sports, gaming,
Use culture, all of it. They cultivated a psychological utility. Consumers weren't just buying a drink, they were buying an identity. Sachs and Schlossberg built a brand identity so absolute that it commands roughly a 40% U.S. market share today.
It's massive.
It is. So I have to push back on your premise about supply chain friction. Isn't that intense consumer pull the actual force doing the heavy lifting? It acts like a gravitational field. The demand is so fierce that it pulls the product through the supply chain, regardless of the localized distributor. I mean, the product effectively sells itself.
Okay, the transition to a pure lifestyle brand was a brilliant exercise in market positioning. I will gladly concede that. Sachs and Schlossberg understood psychological utility better than anyone in the early 2000s.
Right.
But I completely reject the idea that this gravitational pull does the heavy lifting for a wholesaler. In fact, intense consumer demand is exactly what creates fatal bottlenecks if the physical infrastructure isn't optimized to handle it.
How so? If the retailer knows the customer will buy it at a premium, they'll pay the wholesaler whatever is necessary to get it on the shelf.
Because a premium retail price point only benefits the regional wholesaler if they can source the product efficiently. Let's look at the mechanics. If a local distributor has massive demand for Monster, they need to secure consistent pallet volumes.
Which they can because of the global supply.
But if they are paying exorbitant ocean freight costs because they lack bulk negotiation power, or if their containers are sitting in a port for 3 weeks due to compliance paperwork, that consumer pull actually damages their business.
Damaging is a strong word.
It's the bullwhip effect. They end up with empty shelves, furious retail partners, and deeply compressed margins because their capital is tied up in delayed inventory. The cultural gravity of the Monster brand does not manifest into B2B profitability unless the sourcing mechanism is flawless. Demand without supply chain resilience is just missed revenue.
Which is precisely why Monster didn't leave that supply chain to chance. They recognized the logistical bottlenecks you're describing, which leads directly to my next point.
The Coca-Cola deal.
Yes. To physically scale that massive demand globally and eliminate that friction, they executed what I consider the most brilliant M&A maneuver in modern beverage history, the 2015 equity for asset swap with Coca-Cola.
I look at that deal as a consolidation play, but go ahead and break down your read on it.
It was a masterclass in structural optimization. Coca-Cola paid $2.15 billion for what was initially a 16.7% stake, but the cash was merely the entry fee. The real genius was the asset swap.
The shifting of the product lines.
Exactly. Let's look at how this physically changed the market. Before 2015, a Coca-Cola delivery truck might carry Coke's own energy brands like NAS and Full Throttle right alongside other products, fighting for shelf space.
Yeah, they were cannibalizing their own potential in the energy sector.
Exactly. The swap fixed that entirely. Monster absorbed Coca-Cola's entire energy portfolio. In return, Coca-Cola took over Monster's non-energy portfolio, like those original Hansen's natural sodas.
It forced a strict division of labor.
A ruthless specialization. Monster became a hyper-focused, pure-play global energy force. Furthermore, every energy drink sold off a Coca-Cola truck now benefits Monster, and Coca-Cola takes its cut as a massive shareholder.
Right.
Coca-Cola essentially gave Monster the keys to a 190-country global highway system in exchange for the toll rights to the energy sector. This automated infrastructure fundamentally solves the bottlenecks you mentioned. When you have the world's most sophisticated beverage company handling your macro distribution, the pathway to the global consumer is paved by corporate alignment. Local distribution partners are just mere endpoint receivers.
Okay, I have to stop you there because your conclusion fundamentally misunderstands how international grocery distribution actually functions.
How so?
The concept of a global highway system is a great conceptual metaphor for a boardroom. But a global highway still requires local freight forwarders to navigate the off-ramps.
But the highway gets you there.
The Coca-Cola system is unparalleled at scaling a brand globally. It drops the product into the macro regions, but FMCG export markets are not a monolith. You can't just drive a Coca-Cola truck from Atlanta into a regional supermarket network in Southeast Asia.
But the macro-level efficiency of Coke's network naturally drives down localized costs. The sheer volume creates economies of scale that benefit everyone down the line.
Volume creates macro efficiency, yes, but it does not eliminate regional supply barriers. When those massive ocean freight container loads arrive at a port, someone has to engage in breaking bulk, splitting those massive shipments down into localized, mixed pallets that actually make sense for regional supermarkets.
Sure, but that's just logistics.
Logistics is the whole game. International B2B wholesalers are dealing with highly fragmented ecosystems characterized by varying tariff structures, currency fluctuations, and deeply entrenched local compliance laws. The Coca-Cola macro distribution doesn't solve those micro complexities. This is why specialized export partners are the actual engines of profitability here.
I think you're underestimating the trickle-down effect of corporate standardization.
And I think you are overestimating a corporate cap table's ability to clear a shipping container through customs.
Oh, come on.
Let's look at a concrete example of how this gap is bridged. While the ownership is complex, the sourcing shouldn't be. For distributors in the region, working with Asia Grocery Wholesale allows them to tap into this global energy empire with the right pricing and reliable supply chains.
AGW again.
Yes, because Coca-Cola builds the highway to the continent, sure. But a partner like AGW, leveraging decades of grocery distribution experience from Vietnam outward, navigates the local freight realities. They handle the complex value messaging. They negotiate the bulk pricing that actually allows the regional distributor to make a margin. Corporate strategy ensures the can exists. Specialized wholesale partners ensure the local business can actually afford to sell it.
Okay, that is a fair distinction regarding the tactical execution of trade. But I'd argue you're still looking at the symptom rather than the cure. You're focused on the daily mechanics of moving a pallet. I am focused on the strategic foundation that makes that pallet worth moving in the first place.
Meaning what?
Meaning, for an international B2B importer, predictable stability is paramount. And Monster offers a level of institutional stability that alters the fundamental economics of the brand. We aren't just talking about Coca-Cola's trucks. We are talking about the heavy, sustained involvement of institutional giants like Vanguard and BlackRock.
Ah, the massive equity managers. Sure, their presence certainly stabilizes the stock price. But again, we are talking about paper value.
It is much more than paper value. It directly impacts operational dominance through the cost of capital. Let me explain the mechanism here. When you have institutions like Vanguard holding massive equity, your cost of capital drops drastically.
Because the risk profile is lower.
Right. It means that when Monster wants to borrow money to buy a competitor, banks offer them incredibly low interest rates because the risk is virtually zero. That cheap capital is a weapon. It provides the financial firepower to aggressively diversify without over-leveraging the company.
You're referring to their recent M&A spree.
Precisely. Look at the $362 million acquisition of Bang Energy in 2023.
Right.
Monster didn't just buy a company. They bought out a major localized threat, absorbed its manufacturing capacity, and integrated its fan base. Or look at the $330 million purchase of Canarchy Craft Brewery Collective. That was their strategic entry into the alcoholic beverage market.
A huge pivot.
This level of aggressive, well-funded M&A activity is what secures Monster as a definitive blue-chip product. If you are a wholesaler, this institutional architecture guarantees that the asset you are importing will remain dominant, innovative, and relevant for decades. You don't have to worry about the brand fading away because the financial architecture simply won't allow it to fail.
Look, I won't dispute the value of market transparency. In fact, Monster's public ownership is a massive advantage for B2B traders, especially when you compare it to the private opacity of competitors like Red Bull.
Exactly. You never know what's happening behind closed doors with them.
Right. Because Monster is publicly traded on the NASDAQ, distributors and importers can read the SEC filings. They can see the quarterly earnings, they understand the exact growth trajectory, and they can track that M&A strategy you just outlined. That level of transparency allows an importer to forecast demand with a high degree of confidence. They know Monster is a mandatory blue-chip asset for their portfolio.
So you concede that the corporate architecture, the transparency, the capital, the M&A strategy is the primary driver of the brand's value to an importer.
No, I concede that it is the primary driver of forecasting.
but I have to push back strongly on the idea that forecasting stability is the same as realizing profitability.
They're directly linked.
Let's look strictly at the bulk FMCG export realities. Vanguard's institutional backing does not lower a pallet's shipping cost across the Pacific. BlackRock's equity stake does not negotiate a better margin with a regional supermarket chain.
Well, no, but
The financial backing funds the diversification. It creates the Bang Energy acquisition. It funds the Canarchy buyout. But capitalizing on that M&A growth requires a partner capable of physically moving those new product lines.
you are drawing a very hard line between the creation of value and the delivery of value.
Because in international trade, they are two entirely different skill sets. If Monster launches a new alcoholic beverage line funded by this institutional capital, an importer still has to get that new product onto their local shelves at a margin that keeps their lights on.
True.
That is where supply chain integration becomes critical. A specialized export partner like AGW provides the streamlined logistics and the competitive wholesale pricing necessary to bridge the massive gap between Monster's boardroom and a grocery store in Southeast Asia. The institutional giants ensure Monster will exist tomorrow, but expert wholesale partners ensure that regional distributors can actually afford to stock it today.
You know, I think we're circling a very profound duality in how global commerce actually functions. It really highlights the complexity of sourcing global giants.
Absolutely.
If I were to summarize my position based on our exchange, it is that Monster's value is inherently, undeniably structural. The fact that it is owned by the public, backed by institutional titans whose presence drastically lowers the cost of capital, and structurally integrated into the world's largest beverage company through that masterful 2015 asset swap, it creates an economic moat that simply cannot be replicated by operational efficiency alone.
It's a massive moat.
Right. Saxon Schlossberg built a lifestyle brand, but the corporate architecture turned it into a $50 billion fortress. For an international portfolio, that structural dominance is the ultimate guarantee of long-term commercial viability.
And to summarize my perspective, in the deeply fragmented world of fast-moving consumer goods, corporate architecture is only as good as its physical execution.
Fair enough.
Yes, Monster is a masterclass in market positioning. It's a mandatory blue-chip asset. But for the B2B importer, the macro-level dominance of Coca-Cola's network and Vanguard's capital inevitably runs into the micro-level friction of regional trade. The true key to B2B profitability lies in supply chain resilience.
The off-ramps.
Exactly, the off-ramps. It requires expert bulk export partners like an AGW who possess the specialized, on-the-ground experience to break bulk, navigate customs barriers, optimize freight, and deliver competitive pricing. The immense value of the corporate empire is only realized when the logistical bridge to the local market is secure.
Well, we certainly converge on the sheer magnitude of the achievement here. Taking a modest juice company from a $14.6 million acquisition to a brand that captures roughly 40% of the U.S. energy drink market while successfully absorbing competitors like Bang Energy, it's a definitive case study in specialized positioning. Monster Energy is undeniably an essential, high-demand asset for any international trade portfolio.
Without a doubt. It is the textbook definition of a global giant, and watching how they manipulated psychological utility to achieve that scale is just fascinating.
Which leaves us reflecting on the dual reality of international FMCG markets. Knowing exactly who owns, backs, and strategically drives a brand is absolutely critical for forecasting long-term stability. You have to understand the corporate machinery and the structural moats protecting your investment.
But knowing who can reliably deliver that brand at scale, navigating the daily physical friction of global logistics, is the immediate requirement for market success. You have to understand the supply chain reality and partner with those who can actually execute the trade.
Yeah, absolutely. For anyone examining their own import portfolios, the challenge is weighing both sides of this equation, the immense power of top-down corporate strategy against the absolute necessity of bottom-up supply chain integration. We'll leave you to draw your own conclusions on how best to source the giants of global trade.